talk about overhead. So overhead is the most complex because itself is more of an estimate. It's hard to allocate overhead in the first place. So what we have to determine is something called a predetermined overhead rate. And that's our estimated total overhead cost divided by our estimated activity. And that gives us our assigned overhead, which is our predetermined overhead rate. We talked about this in previous classes about how we have to estimate on using activity-based costing or some kind of metric on how overhead will be applied because it's so abstract. It's electricity, it's rent. How do you apply that to a specific product? And so we have to determine our allocation base, choose a predicted activity level, and then compute the standard overhead rate in order to determine the total overhead cost or the standard overhead costs. And so here is an example of a flexible overhead budget where they predict an 80% capacity level or activity level to determine the standard overhead rate. And so this is getting a little too complex. The whole thought here is that you can figure out an overhead rate, a predetermined overhead rate by a flexible budget. So if we say we expect an 80% activity level here, we can predict a $2 per unit cost or overhead allocation because we are doing it by labor hour. So they're saying, hey, at 80% here, we have total factory overhead of 8,000. 8,000 divided by 4,000, our total standard direct labor hours gives us a $2 rate, which we're going to use to apply the overhead. And so we'll always have to know what our predetermined overhead rate is. That'll be given to you, or it'll say it's something like it's calculated by an estimate of 80%. We're using it by direct labor hours. And so you just know, oh, our factory overhead's 8,000, our standard direct labor hours is 4,000. Standard means estimated, right? And we have to make an estimate for this. And so then we just divide the two to get our predetermined overhead rate. And so this is where that's the component that that makes this a little more complex than direct materials and direct labor. Overhead, we have our actual overhead cost variance equals our actual overhead incurred. That's easy to get, right? That's just our bill of our rent, electricity, whatever we're saying overhead is, subtracted by our standard overhead applied. This is the complex piece. How do we determine how much we applied? So here, our overhead cost, we're using this thought again. Actual variable overhead was 3,650 and fixed was 4,000. And so that's easy. These are our bills. And so maybe this was our electricity, this was our rent. We can say our actual overhead incurred was 7,650 by adding these two. That's easy. Our standard overhead applied, it's $2 per labor hour. So we say our labor hours was 1 labor hour per unit. So 3,500, that's what we got from our previous one. So our 3,500 hours multiplied by, so we got that from our labor variance assessment times the $2 rate, which we just assessed, gets our $7,000. So we have an unfavorable calculation of 650. That's our total overhead variance. But what caused that variance? We can have a few issues that cause that variance that are controllable, right? That's the whole point of management, is to investigate controllable costs. And so what are those controllable costs? We have controllable costs and volume variances. So we'll go into it. Overhead controllable variance and volume variance. Controllable variance is the actual total overhead occurred less the budgeted total overhead. And then our overhead volume variance is the fixed overhead against the applied fixed overhead. And so these are slightly different than our labor and direct materials. So it's similar format, but try to get it out of your head because the previous ones, because the calculations are different. Overhead variance is easy. What we expected versus what we incurred. The total overhead is easy. The controllable versus volume is a little more complex because we're looking at against budget. So how much did we incur? Actual total overhead versus budgeted total overhead. and then what's our budgeted fixed overhead against our applied fixed overhead. So this applied piece is where we get our difference. Both of those together will equal our actual total overhead minus our total overhead applied, right? That's the difference here too. This isn't what we estimated, it's what we applied. So make sure we understand those differences. Applied is what we used our predetermined factory overhead rate to do, right? And what we spent and estimated is our actual versus our standard rate. And so here, our overhead controllable variances, we had a total overhead variance of 650. Our volume variance is 500. And so our controllable variance unfavorable is 150. The overhead volume variance is budgeted fixed overhead of 4,000. Applied, we applied 3,500. So our volume variance is 500. And so these are just algorithmic. We know here that budgeted fixed overhead as a predicted capacity was 4,000. And we know how much we applied using the standard rates. So ultimately, we can determine what was unfavorable. Memorize these differences and do a lot of practice problems related to the overhead. And I have some other practice problems that I've given in some video lectures as well that I'll share with everyone.